But let's chat about what's happening within the consumption space. And we've got Abneesh Roy joining into the show right now. Abneesh, hi, good morning. Let's take it off from where Snehi left right now. This downgrade coming in on sell and the kind of mixed opinion out there it is. What is it that you believe would be the future of, retail plays like Trent at Novama, which have already seen a fabulous run up? The valuations are expensive still at the current, after the current correction as well, which is played out in the stock.
Sure, thanks. We are positive on trend, so we continue to have a buy, and one of our topics in apparel space. And we do see in the near term, medium term, trend will remain in the top tier in the peer set in terms of growth. We do see huge headroom for expansion in Zudio, in West Side, even in terms of the emerging categories. If you see BPC, innerwear, footwear, that was around 20% of the business, and that's also growing. And even Star Bazaar is doing quite well. So we remain positive. We have a buy, and it's among our topics. In the near term, of course, marriage season should definitely help. We did see, for example, Shoppers Stop also report a decent set of numbers. So we are not negative. We are, in fact, quite positive on that.
Quite positive when it comes to trend. Hi, Abneesh. This is Shrishti also joining in. Wanted to have your take on the staples then, because from the budget, there are a lot of hopes building in that it might give some boost or some leg up when it comes to the consumption basket. What are your thoughts on that? Because just in the Q3 updates, we have seen a sort of a mixed bag coming in, while the market's giving a thumbs up to some of the updates from Marico, but Dabur wasn't looking that great. So what are your hopes for this particular calendar year when it comes to the staples then?
Yes, absolutely, you're right. From the union budget on February 1st, there'll be an expectation that on the urban slowdown, which is impacting the lower end of consumption, there has to be some benefits in terms of the income tax, in terms of threshold taxation. At the lower end, clearly, we see a problem, and we have been highlighting that 2 more quarters of pain in urban consumption will be there. That's why if you see the updates which have come in Q3, Marico is seeing good growth because Marico's foods and personal care business that caters more to the mid and premium end of urban consumption, and even in the rural, they're seeing good growth. While Dabur, if you see, is more of a mass consumption, and we have pointed out that Campa Cola impact is there on Dabur's fruit juice business, on Nishko business of Tata Consumer, and of course on Varun Beverages also. The impact of Campa Cola has started. So company-specific, some competitive issue is there on Dabur, but clearly lower end of consumption expectation is in the union budget some benefit, because rural consumption is doing quite well after all these stimulus programs. So on urban, I think government needs to do something.
The competitive pressure in the beverage industry in your latest notes as well. But what about QSR? Things looking on the mend after Jubilant's provisional data?
No, not necessarily. We cannot extend that to the entire sector. Of course, QSR sector, if you see, last 2 years has been quite challenging for most companies. So base has become favorable. But as I said, in terms of urban consumption at the lower end, and a lot of the QSR are, of course, mass consumption now. There is still a challenge, because in the urban consumption, rents being quite high, the salary wage hike has been below the desired level. Inflation is still high. Some bit of the food inflation has cooled off, so that's positive, but I don't think that's enough. So Jubilant Foods growth is more of an outlier, and we would expect that most of the other QSR will be lower in terms of growth, and we would expect them to be more like a low single digit SSG growth, or maybe flattish. So Domino's is an outlier. They are gaining market share. They are aggressive on the delivery format. They have become more competitive. So clearly, the market leader is going for market share expansion, and the other players will be seeing a lower number.
Point taken. But since there is Reliance's earnings today, and I know you don't track it actively, but Reliance Retail, I'm sure, is something that you watch out for. What are the internals that you look at for Reliance Retail today?
So what's happening in terms of the grocery, because we have seen DMart's margins being under pressure. So DMart did report good top line growth. which I think initially the street liked, and the store expansion was good. So similarly for Reliance in terms of grocery business, what is the margin pressure? Because clearly Swiggy, Zomato, Zepto are becoming quite aggressive in terms of the expansion, and in terms of the share also they are gaining from the FMCG companies in terms of the distribution. So net physical retailers will see that challenge. On the jewelry business, clearly I see good numbers. We have seen Titans already, the update has come, and other jewelers. So that should do quite well even for Reliance because of the marriage season and strong gold prices. So these are the two main metrics, and going ahead also marriage season for the next 2 quarters also remains quite strong. So yes, I think the numbers should be better for most of the retailers because of all these reasons in the near term.
Right. I don't know, Abneesh, how closely you are looking at the entire QCom and ECom space. I mean, two players as it may be and a duopoly within the listed universe right now, but it's pretty a neck and neck when it comes to competition within the entire segment, and especially in the QCom space. Having said that, the valuation comfort, I guess, is more in Swiggy right now versus Zomato.
You're right. I will not be able to comment on that. I don't cover them. My comment was more from FMCG perspective and competition to the physical retailers. But when I see the FMCG also, they are quite positive on Q-commerce. Now, if you see in the overall e-commerce, Q-commerce is almost 40% of the e-commerce for FMCG company. And it is margin accretive because on the quick commerce, a lot of impulse purchases there, a lot of premium products, larger packs are also now being sold. And clearly the intermediaries are much lesser. So it's a channel which is clearly going to gain share from the Kirana and possibly even the modern trade. So we are quite positive from an FMCG perspective. We see that the D2C startup companies in the FMCG space, I think they will see tougher times because the larger legacy companies like Marico, Hindustan Unilever, Godrej, etc., have now learned the D2C way of working, and they are also going to be quite aggressive on acquisition. So I will say quick commerce, e-commerce, definitely good days ahead, and definitely for FMCG, those are channels which are of very high priority. So we'll be positive. In the discretionary space, we like liquor companies a lot. So you will see in Q3 results, which start next week for FMCG. You'll see United Spirits reporting very strong number. The stock had sold off because of the change in MD, but we are not at all concerned because the new MD also comes with a Pepsi kind of a strong experience and background. And definitely the template is there, and Hina Nagarajan will be ensuring that seamless transition happens. So United Spirits is something which we are quite positive in the discretionary space.
So definitely positive on the liquor space, but one of the other headlines, Abneesh, that we have been tracking and talking about is the Haldiram stake sale. Because of this, while it's been going a lot, but now that we are seeing some bigger names coming into play, definitely it's still in works. But any take on that? Because I believe that you cover Bikaji Food as a play. So if this happens at a decent valuation, can this be a re-rating trigger for some of these other companies in the same segment?
So definitely snacks and the Indian snacks segment is quite attractive to investors. And Bikaji, in fact, in CY24 was one of the best performing the FMCG stocks. Near term, clearly for all namkeen and bhujia players like Bikaji is challenging. Because 25% of the raw material is palm oil, and that has gone up 30%. So you will see significant margin pressure for Bikaji in December quarter and disappoint the street versus even earlier muted expectation on the margins front. My sense is Q4 should be better. Already Bikaji and other snacks companies in Q3 have taken around 2.5% price hike. And my sense is further similar hike is going to come in the coming weeks. So I would say that is more important thing to watch out, where palm oil settles, where the pricing happens, because clearly the near-term numbers will be weak. Now, coming to a specific question on Haldiram, see, that has been in discussion now for almost 2-3 years. And of course, we do see that a lot of good bidders will be be there, given it is India's largest company in that space with obviously superior return ratio, superior margins. It would be attractive. But please note that even without Haldiram's transaction happening, Bikaji stock gave one of the best returns in CY24, and the cool off happened because of the palm oil. So I would say the business fundamentals of growth and margins are more important than just a transaction, because Bikaji is now a well-known and well-understood story for the investors.
The other, transaction which is underway, Abneesh, is of course in the paint sector with AkzoNobel being on the block. Chatter suggests that Berger is bidding quite aggressively for that. Who do you think is best placed to take that up, and what's your assessment of that deal transaction?
So I would say that we'll have to wait and watch, and my sense is it could take some time, maybe 1-2 quarters at least, because these are transactions in which there is a process, because they are also getting the chemicals part of the business away back to the parent. So that itself will take some time. Coming to potential suitors, I think clearly in our view, and this could be wrong also, Pidilite and Berger seem to be the best place to acquire, because Pidilite does have ambition in the decorative paints. They have been in exterior paint for 15 years, and they have launched their own paints, Haisha, in terms of deco interior paints. But getting Akzo will be a great business for Pidilite. Pidilite is very, very active on M&A. Plus, AkzoNobel Dulux brand at the top end is a very good asset to have, 5-6% market share. Similarly for Berger, I would say very similar kind of a factors will be at play, because Berger is more at the low end and the mid end. They don't have too much of presence on the top end. So I would say these two players seem to be the more likely candidates. But as I said, it could be any other player also. Why not the other new entrants, for example, say JSW or say even other players? Nothing can be said no, because I think still the transaction is at the initial level. Media speculation, I would say, is running ahead of what the actual process is. But yes, this would suggest that clearly for Asian Paint, the competitive intensity could go up, because Pidilite and Berger clearly are bigger companies than Akzo. So once, say, Dulux brand comes under their fold, they will take the brand higher than what it is currently. So that is incrementally a bit negative for Asian Paint whenever it happens. But we do see Asian Paints not being able to acquire, given the CCI issue in terms of market share. So most likely other companies should be the potential bidders in our view.
Quite an interesting take there, Abneesh. Thank you so much for your time. Pidilite as well as Berger should be the top suitors for Akzo, and that would spell further bad news for Asian Paints perhaps.
If you like this video, then like, share and subscribe to ET Now.